Hey there, it's Walter here. Welcome aboard. Glad to have you here today, guys. So, we're going to talk about how to tweak your system and make it better. So, that's basically what we're going to talk about today. Really simple. I'm going to show you an example of a strategy, how I tweaked it, what happened when I tweaked it, and how I tweaked it even more. And this is the kind of thing that, before I forget, this is the kind of thing that we're going to be talking about in an upcoming course called Small Accounts, Big Profits, where we take a very tiny $1,000 trading account and we ramp it up rather quickly. So these are the sorts of things we'll be talking about in that class. Let me show you on my screen here what we are talking about. So first of all, probably the most important thing here is the system, like the strategy. So let me just kind of explain the strategy, and I'll give you the stats here so you can follow along. So basically, this is a strategy where we're trying to hook into a trend. And in this, what happened here, let's say this was like a nominal $50,000 account that I went through in Forex Tester. So you can see where it says starting balance right there, 50,000. And then what we did was we went through Forex Tester and we worked out after 51 trades, it was up 68% essentially at 84,000. And this was using the 3-bar exit. This 3-bar exit is the same 3-bar exit that I talk about in the book Naked Forex. Doesn't really matter to me if you have the book, but it's available at any bookstore that has trading books or whatever. Here it is right here. So this is the book Naked Forex. That one, that's the one. And I talk about it in the book. I wrote about the 3-bar exit, and I really like the 3-bar exit. However, one of the things that I've noticed is that something that's been rather consistent over time that I've noticed about traders is that we tend to make two simple errors consistently when it comes to trailing exits. And in particular, what we do is at the beginning of the trade, we like to have our stops really tight because, of course, that means the market doesn't have to go that far for us to capture a lot of profit. So if you have like a 10 pip stop and the market goes 50 pips and you cash out, you've made 5R on your trade, right? So it makes sense why you want to have a tight stop. But I think typically what we do as traders is we put our stop too close in the beginning. We should have it a little bit looser. And then as the trade goes in our favor, we tend to get really wide and really loose with the trade. And that's when we should be really tightening up. And that's what my testing has shown. So let me show you how this sort of played out when it comes to this strategy, this trend trading strategy. So what happens is this $50,000 account goes up with a 3-bar exit to 100 and what did I say? To 80,000. So it was up like 68% or whatever. Okay, so 168.1. That means it was up 68.1% using the 3-bar exit. Now, take a look at what happens when we use a different trailing exit, which is actually very loose in the beginning, and it gets much tighter later on. So this is a more it takes a while for it to move into profit. Actually, that's how it works. So all you can see the numbers here. We're still risking 2% in both cases, but the end result is very different. You can see that this one at the end of the oh, sorry, that's the wrong one. Here we are. There we go. So this is the trailing exit one at the end of the test here. Same exact trades. The only difference is I just applied the different exit. It's up 89%. So at 94,000. So it's quite a difference, isn't it? To go up from being up 68% and moving a $50,000 account to 84 grand. It's quite a difference in the test when we got to 94. Anyway, so now what I want to do here is actually share with you these stats. So this is the 3-bar exit. It had a 66.7% win rate. So that means that 33.3% of the times it loses. And then when you look at what it does in terms of the reward to risk ratio, it ends up being really just basically 1-to-1, a little bit better than 1-to-1 with your 3-bar exit. And the reason why that's the case is because it gets out of a lot of trades with a very small profit. And it's quick to kind of move to break even and beyond. So it's pretty tight with the trade from the get-go, right? So you can see here the average win is 14, and all this comes from the page over here. So here's your 3-bar exit. You can see the average trade, the average winner is 14.10 right here, 14.10 71 cents, 13.82 and 88 cents is the average loss, and it works out to be the reward risk ratio is basically 1-to-1. We're risking fixed fractional here. We're risking 2% per trade, right? Now when you go and move, and so this is your average winner, this is your average loser. It's basically a 1-to-1, just slightly better than that, very slightly. And so the expectancy is $480. The way that you interpret that is essentially we expect that you would make, on average, you would make $480 for every $1,383 that you push through the strategy, right? That's how you interpret that. So you're making about $480 for every $13.83 that you risk, okay? So that's how you interpret that. Now let's look at the other numbers over here, which is the trailing exit, which is has a lower win rate, okay? So it's at 43.1%. So remember, we had over here, I'll show you actually on the spreadsheet. Over here, we actually had a 66.7% win rate with the 3-bar exit. Our win rate goes down with the trailing exit. However, the overall profitability goes up. So it's 43.1%. That's quite a drop in the win rate, really. 66.7 to 43.1. So you may be more uncomfortable trading the strategy this way with the different exit. And notice how the exit is actually the big deal. The exit is what changes your win rate. The entry usually doesn't do much. It's really the exit that, I mean, you can do certain things to change it, but the easiest way to improve a strategy is to work on the exit, which is what I'm trying to. And the second most important way to improve your strategy is the way that you manage risk, and I'm going to show you that too in just a minute. And which again, this is what the Small Accounts Big Profits course is all about. So if you like that kind of stuff, you might like the course. All right, so I'll share with you now the expectancy for this one. So now we're at 2.28 reward to risk ratio. So even though our win rate's gone down to 43.1, we've actually bumped up our expectancy overall, which is great. The average winner is now $3,158. The average loss is still $13.83. So our expectancy is now up to $574. So what we're saying is for every $1,383 we push through the strategy, we're expected to make $574, right? So it's improved quite a bit. Now, here's where the real magic comes in, because what I want to do now is share with you I'll share with you the charts. Okay, so this is a chart. What you're looking at here is actually the 3-bar exit is the dashed one here, the dashed line, and then the trailing exit is the solid line. So if I go like this, I can make it a little bit bigger. I know sometimes it's hard to see on these screens, but basically that's what you're looking at there. So it's really kind of cool how you can see the effect of the trailing exit. I mean, they're the same trades. That's why these curves are kind of hugging each other. But what typically happens when you use this trailing exit is it jumps up higher when you get a winner. So what's happening is, and I looked at this, what's happening is a 3-bar exit is truncating your best winners, okay? It's also truncating your worst losers, so to speak. So it's kind of keeping your trades in the middle. Kind of, if you think of all of your trades in a bell curve, the 3-bar exit kind of keeps them clumped there in the middle of the bell curve. Whereas what happens with this trailing exit is it allows you to profit more, and that's never more obvious than it is here with the big jump up in one of the last 2 trades, it looks like, because when you get a really nice winner, it's a really nice winner, right? And also, you'll notice that the drawdowns are slightly steeper here with the trailing exit. And that's because, again, when the market goes in your favor, it takes a little bit longer for this trailing exit to kind of catch up to price and actually start tightening around price, right? So that's why that happens. So now what I want to do is share with you what it looks like when you start to apply like an aggressive risk management. So here again, these are the two curves that we talked about before. Remember, the red one is the 3-bar exit. So using this aggressive risk algorithm called profit bricks, which we're going to talk all about, and we're going to use this in the small accounts, big profits course. What's interesting here is how you don't get the massive jumps up that you get when you're using the trailing exit, the other trailing exit. 3-bar exit doesn't really get, I mean, it still makes more money here than when it did with just the normal 2% per trade fixed fractional. Because remember, that topped out at 68 grand. So again, these are the same trades that we were looking at before, but now with the 3-bar exit, you get all the way to 92,000. So basically where we got with the trailing exit, right? So the 3-bar exit is basically now as good as the other one. So it's up, whatever that is, 98% or something like that, 97% on the test. And now here you see you've got this stair step effect here when you're trading the other trailing exit. And so now it tops out at 155,000, which is a huge increase from the 93,000 that it was at before. So that's really, that happens, that effect comes from simply getting a little bit more aggressive and compounding your trades at the trade level rather than the account level. And that's how that works. So this is something I want to share with you, see how, one, we really need to look at the exits when we're trying to tweak our strategy. And number two, we should probably start to look at risk management algorithms. And really, if you want to change the way that you manage risk, let's say that you use a fixed fractional method, which most traders do. You can use my risk calculator here. It's at fxjake.com/risk. And you can just go there and plug in your numbers and see, what kind of likely drawdown you're going to get and that sort of thing. So that's basically how that works. It's interesting. I traded a long time before I realized that you could change, that there was another way to improve your strategy. Most of the time as traders, we're looking at the entries or the exit rules, and we're not really looking at risk rules. And I was the same way. And it was actually funny. I was reading a story recently about chocolate, and I've been eating chocolate a long time. Let me assure you, it's been most of my life, right? Been eating chocolate. And I always thought that there were two, and I even went to a chocolate factory because I love chocolate. I like to see how they make it and stuff like that. And it was really cool. And they talked about how the white chocolate has so much higher fat content. And they basically just take the cocoa butter out of the cocoa beans. They don't actually use the same stuff that they use to make dark chocolate and milk chocolate, right? But there's actually another chocolate. It's called ruby chocolate, I believe. And they actually use a different cocoa nut, and it has a slightly different flavor. And so I was like, wow, have you ever heard of this ruby chocolate? I never heard of it. And that's kind of like, and when I was thinking about this today, I was like, yeah, that's kind of like how I was for years with trading. I was always kind of looking at the entries and the exits. And I learned that after time, exits is kind of really, really where I want to be. I want to be looking at the exits here. That's where the real meat is, sort of, so to speak, the meat on the bone that you can get for your trading. And that's obvious. I shared that with you here today. But even better, the secret sauce, so to speak, is the risk algorithms and how you manage risk. And if you're willing to put up with slightly deeper drawdowns, the payoff can be exponential, right? And so this is something, I mean, we've seen this over and over in traders, right? If you look at, for example, Ralph Vince, the story about Ralph Vince. Ralph Vince basically was tasked with coming up with a method of increasing the growth of trading accounts, right? And his buddy Larry said, hey, I'll deal with the trading and the systems. You tell me how much to risk. And so he worked it out. And basically using the formula that Ralph came up with, which is hyper super aggressive, and I don't recommend that you use that. I think there are better ways, but nevertheless, Larry and his daughter both just beat the pants off everybody else in this trading contest. They both totally took their, and again, you know, when you think about it, a lot of these traders, we're all trading very similar systems. It doesn't matter if you're using price action to get into the trend, or moving averages, or the MACD, or the Bollinger Bands, or whatever. You know, most trend followers are going to get in around the same time, right? And they're probably going to get about the same. You know, some have better exits than others in some situations, or, you know, what have you, depending on if it's a volatile trend or a not so volatile trend. So we all basically have correlated results. It doesn't really matter what you're using, right? But as soon as you add the secret sauce, the risk algorithm that can expand the results and really amplify, that's really what risk algorithms do for your trading, is they amplify it. So like if you think of a song might sound really nice on the guitar. I don't play the guitar. Hopefully this analogy works. But you know, you're playing a song on the guitar and it sounds nice. You plug it into an amp, it sounds totally different. It can be really loud, even though you're just playing, you know, a string guitar or whatever. It's, even if it's not an electric guitar, if it's amplified, it's like, whoa, it sounds better, I think, really. But it's the same thing with trading. You know, I showed you these curves. These curves are drastically different depending on how you amplify the results using a different set of risk rules. So you literally go from this chart right here, where we start at 50 grand, we top out at, what is that, 84 grand and 94 grand, right? Or we all of a sudden get hold on. Or we all of a sudden get here where we're topping out at 94 grand versus, or 92 grand versus 155 grand. So it's a big difference, isn't it? It's a big difference. So that's kind of the thing that I wanted to share with you today. I hope it helps. I wish you happy trading. Thanks so much for spending time here. If you want to join us in small accounts, big profits, you can go to fxjake.com/big, or click the link below this video. Otherwise, I'll see you in another video soon. Take care. Bye. See ya.